Hello, this is Greg Giardino,
And I'm Allison Hall.
and this is It's Your Smarter Money. And today we want to talk about a very popular topic, which is on annuities. So, what is an annuity? Do you need one? I know there's a lot of things in the press around annuities. They're in retirement plans or someone's trying to sell me annuity. So, let's talk a little bit more about what an annuity is and if you really need one. So, what is an annuity? In its simplest form, it's really an insurance contract between you and an insurance company. It's simply what we call a tax-deferred investment vehicle. So whether you have it in an IRA or outside of an IRA, your investment gains will grow tax-deferred. So that's unique around annuities. And you may be thinking, well, I thought an annuity was an investment. Think of an annuity really as insurance for your investments. So keep that in mind. And when it comes to annuities, there's two main phases of annuities. There's the accumulation phase and there's the payout phase. So just like it sounds, the accumulation phase is when you physically put money into an annuity. It could be a lump sum. You could put periodic payments into them, and your investments will begin to grow tax deferred. Where the payout phase is also known as the annuitization phase. So that's the phase when you really start to draw money out. And all annuitization means is simply you give up your money to the insurance company and they can pay you a guaranteed income stream annually for the rest of your life. So that's what we mean by payout phase. So there's also two different flavors of annuities or main flavors. There's the immediate annuity and the deferred annuity. So immediate is just like it sounds. These are often called SPIAs, SPIA, single premium immediate annuities. Those can pay you the income stream right away starting today. Where the deferred annuities allows you to grow with interest and defer the annuitization to a future date down the road. So there's three main types of annuities. There's what we call fixed, variable, and index. So fixed annuities, think of them as paying a fixed guaranteed rate of interest. Think of them almost like having a CD. I can have a multi-year annuity that's fixed that over 5 years can pay me 4% a year, or over 10 years pay me 4% a year. That's a fixed annuity. A variable annuity is invested in various funds. So they're similar to mutual funds. You can get a little bit more interest investing in a little bit more of aggressive variable annuities. And then finally, indexed annuities give you a floor and a cap. So you can invest it in, let's say, the S&P 500 index. If the S&P 500 takes off and is up 20% in 1 year, the most you can get credited on your indexed annuity is, let's say, 10%. So that's the cap. And let's say the market goes down and loses 5%. The worst you could lose is maybe, let's say, 0. You don't get any interest. So that's common with indexed annuities. Now you may be thinking, who is right for an annuity? So let's say, for example, you saved up $500,000 for your retirement. Most financial planners would recommend maybe withdrawing no more than 4% from that portfolio to last the next 30 years. So on 500,000, that's about $20,000 a year. With a immediate annuity, instead that person can maybe withdraw closer to 7% off of that 500,000, or let's say $35,000 a year. That can make a big difference for someone maybe who didn't do such a great job of saving. Of course, if you want guaranteed income, this is the only product in the world that can give you a guaranteed income stream, once again, based on the strength of the insurance company. If you're more on the conservative side, annuities tend to be more appropriate. And also, if you're a single person and you don't care about leaving a legacy, annuities could make sense. Now, annuities aren't usually the best asset to leave behind to your children because they do not receive what's called a step-up in basis. So if you opened up a Charles Schwab brokerage account, for instance, you put $100,000 in, and when you passed, you left $1 million in that account. Well, for tax purposes, the starting point to your children would now be $1 million. That's a huge benefit. Unfortunately, with annuities, they do not have a step-up in basis, nor do they receive preferential capital gains treatment as you would with an individual brokerage account through a Charles Schwab or so. So I know we just went over a lot here. I'm going to swing things over to Allison so she can give you a deeper dive into some of the important features you need to know about annuities.
So as Greg alluded to, these are some of the most complex products in the finance world. We only have a couple minutes, so I'm just going to touch on some of the important features to be aware of. First, they can have early withdrawal penalties, and that really covers two things. So there's the IRS rule, which unless one of a few very specific exceptions applies, if you make a withdrawal prior to age 59 and a half, you get dinged with a 10% penalty. And to be clear, that's on top of ordinary income tax you'll be subject to. Then you have the insurer's penalty to be on the lookout for, which is triggered if you take a withdrawal during what's called the surrender period, even if you're of age. So for most annuities, that's a 5 to 10 year period right after the contract is purchased. That said, most contracts do allow 10% to be tapped annually without being subject to that insurer's penalty. So you're not completely locked in if you're in a product that no longer serves the need or if you need access to cash. There's also what's called the free look period or the right to return. This is a grace period, usually 10 to 30 days from the purchase, where you can cancel the contract and receive a refund with no questions asked. Next, they can have high fees and commissions. So immediate annuities without riders usually aren't terribly offensive, but variable annuities can get out of hand fast. The broker or agent who sells the contract can be compensated anywhere from 3 to 7% of the purchase price on top of commissions. The funds that annuities invest in often have high expense ratios, and all of the bells and whistles called riders that you can add on for certain benefits all come with a cost, sometimes as high as 1%. That cuts into your bottom line. While we're talking returns, I'm gonna jump around on the slide a little bit here, use this opportunity to bring up a common misconception. Most investors think that when they receive an annuitization quote and the insurance company quotes a payout rate of 7 or 8%, that's the rate of return they're receiving. But unfortunately, it's not the case. When you annuitize your contract, you're giving up your investment entirely to the insurance company, and then they're effectively just paying you back your money. Let's say after 15 years or so, you receive your full principal and growth back. At that point, the insurance company goes into their pockets to start paying you. So really, to calculate your true rate of return, you need to start at the point where the insurance company is paying out of their pocket. Only then can you really calculate your true rate of return. And on most annuities, it's not uncommon for it to be, 3 to 5% per year, not the 7 or 8% payout rate. Probably the most attractive feature with annuities is that unlike 401ks and IRAs, there are no contribution limits. So this can really allow an investor who either, doesn't need funds in the near term or who maybe has high income to really ramp up their tax deferred savings. I think that covers some of the most important things to be aware of. So Greg, throw it back to you. Take her home.
Thank you, Allison. And we hope you learned a little bit more about annuities. Yes, they can be really complex. I think the take-home point is if you have questions about annuities, does it fit into my financial plan? Please don't hesitate to reach out to us. Our Atlas team would be happy to help you walk through what are some of the pros and the cons, and if it makes sense for you. So once again, hope you found this valuable, and until next time, we'll see you soon. Take care.